Aloha students, welcome to the lecture on Chapter 5. In Chapter 5, we're talking about revenue recognition. In other words, when do we recognize revenues and profits? Okay, the general rule for revenue recognition is that we record revenues when the earnings process is complete or virtually complete. So that means we've done what we are going to do for services, or we have delivered the goods. So again, when we deliver the goods or perform the services, and there's a reasonable certainty as to collection, so we have a really good chance of receiving the cash, then we record the revenues. Okay. And remember, under the accrual basis, we don't have to wait until we get the cash to record revenues. Again, we record it when we've done what we need to do to earn the revenue. So we've delivered the goods or we've rendered the services. Let's skip this. Okay, so again, this is indicating that the primary trigger, I guess, for recognizing revenue is here, that you've completed your contract. You've delivered the goods or you've delivered the service. Here's a slide that shows the differences between US GAAP and IFRS. Remember, for GAAP, it's the earnings process is complete and that there's a pretty good possibility that we're going to collect the cash in payment. Yeah, similar kind of definition for IFRS, just slightly different. So, but essentially it's the same thing. Okay, so here's another recap. Recognize revenue when the product or service has been delivered and cash has been received or a receivable has been generated and there's reasonable assurance of collectability. Don't worry about that slide too much. Okay, so there are certain, I want to say exceptions or certain unique types of revenue recognition issues. The first is installment sales. So installment sales are when a retailer sells a product to the customer and the customer, rather than paying in full immediately, arranges with the retailer to make payments, usually monthly payments for 1 year, 2 years, maybe even up to 3 years. Okay. Those are called installment sales. So the customer takes possession of the product, but then makes monthly payments thereafter. There's two ways that we account for installment sales. Those are called the installment sales method and the cost recovery method. Let's look first at the installment sales method. Under the installment sales method, let's go through the example. November 1st, this Belmont Corporation real estate developer sold some land for $800,000, and the buyer, is going to make 4 equal payments of $200,000 plus interest each November 1st. Whenever there's an installment sale, there's almost always interest that's associated with it. The land originally cost the developer $560,000. Okay, so the first step in the installment sales method is to figure out the gross profit percentage. Since the land costs $560,000, the company's going to sell it for $800,000. That's a $240,000 profit. You divide that profit by the selling price, $800,000, and that gives you the gross profit percentage, in this case, 30%. So under this installment sales method, every time cash is collected, 30% of that represents gross profit. So $200,000 is collected every year. So 30% of that, or $60,000, is the gross profit to recognize each year. Okay, so under this installment method, gross profit is recorded as cash is received. So the profit is spread out over however many years that cash is collected. So notice the journal entries related to the installment sales method. When the installment sale is first made, installment receivables is debited. That's for the total amount of the sale, because that's ultimately how much is collected from the customer. The cost is removed from inventory. So inventory is credited for $560,000. That was the cost of the land that was sold. And the difference, the profit, is not recognized immediately, but is put into a deferred gross profit account. Okay. When cash is collected, you debit cash, credit or reduce installment receivables for the $200,000 collected. And then at the same time, since we've collected part of the cash, we can recognize part of the profit. So we make the third entry by debiting deferred gross profit. That reduces the deferred part of the gross profit by the $60,000, which was the 30% gross profit percentage times the cash received. And then we go ahead and realize or record the profit by crediting realized gross profit for $60,000. Okay, so again, 3 journal entries that are made for installment sales method. The first to record the sale at the time of the sale. The second to record the collection of cash every time cash is received. And then the third entry is every time cash is received, we can recognize or realize part of the gross profit, and we remove that from the deferred gross profit. Okay, another method under the installment sale method is called the cost recovery method. Under the cost recovery method, we don't recognize any gross profit until we get our money back, until we recover our cost. So in this example, again, the land example, November 1st, 2013, we collected $200,000 of cash. So that is applied against the cost. And since the cost was $560, it doesn't cover the entire cost. So all of it goes to cost recovery. None of that $200,000 is gross profit yet. The second year, $200,000 is collected. So that accumulates to $400,000 of cost. So we still haven't recovered our cost of $560 yet. So all of that goes to cost recovery, none of it to gross profit. Third year, $200,000 cash is collected again. Of that, $160,000 goes to cover the cost, because now we've covered the entire $560,000, the 200 plus the 160. So the remaining $40,000 of that $200,000 then goes to gross profit. And then the next year, the $200,000, since we've already recovered our cost, all of that goes to gross profit. Okay, so the cost recovery method again, we don't record any gross profit until we've recovered all of our costs. Then after we've recovered our costs, everything received after that is all profit. Here are the journal entries related to the cost recovery method. As you remember, in the first journal entry, we record the sale, and this is the same journal entry that we saw earlier. Debit installment receivables for the sales price, credit inventory for the cost of whatever it is we're selling. The difference is deferred gross profit. Every time we collect cash, we make the same entry that we made before: debit cash, credit installment receivables. In this case, $200,000 a year for those 4 years. But now, to record or recognize the gross profit, remember, going back to the previous slide, there's no gross profit recognized in year 1 and year 2 because we have not yet recovered our cost. Therefore, there's no entry to record gross profit in the first 2 years. The third year, we record $40,000 worth of profit from here. Okay, so we debit deferred gross profit and we go ahead and realize gross profit for that $40,000. And then the final year, the fourth year, the whole thing, all $200,000 received goes to profit. So we deferred gross profit, credit realized gross profit for the entire $200,000 cash received. So the entry is the same as we saw in the installment sales method. It's just that the timing of when we recognize the gross profit is different. Okay. There's actually a third method of accounting to use for installment sales. And again, these are all options, 3 different options or alternatives we can choose. The third option is called the point of delivery method. And under the point of delivery method, we recognize the entire amount of the profit immediately. So the entry would be debit installment receivables for $800,000, credit inventory $560,000, and then credit realized gross profit for the $240,000. We are recording the entire gross profit for the whole thing up front as soon as we make the sale. So there is no entry thereafter to realize gross profit because we're doing it all at the beginning. And again, that's called the point of delivery method. Okay, so those are the 3 methods for installment sales. Don't worry about that for now. Consignment sales. Okay, consignment sales are when a seller has someone else sell their goods for them. Okay, might be somebody who doesn't have enough volume to have their own store, so they ask someone else to sell it for them. And in return, the person selling it, the consignee, will take a percentage of the proceeds. Okay, so for example, if I'm a seller of homemade jewelry, I make jewelry, but I don't have enough to have a retail store, I ask a jewelry store, please sell these goods for me, and I'll give you, for example, 20% of the proceeds. The goods still belong to the maker, the consignor, okay, the person who made the jewelry in this case, and they still have the risk of ownership, so the consignor still owns the property. The consignee is simply selling it for the consignor. Okay, so they don't own it, they don't have the rights to it, they're just selling it for someone else. Okay, that's a consignment sale. Okay, another issue with revenue recognition is that of long-term contracts. So under long-term contracts, these are contracts that usually construction type contracts that last longer than a year. So the question becomes, when do we recognize the revenues and the profits for contracts that last longer than a year? There's two basic methods we use for long-term contracts: the completed contract method and the percentage of completion method. Well, let me explain these, I guess. Okay, the completed contract method says you don't recognize any of the revenues or any of the profits until the contract is completed. So if it were a 3-year contract, for example, there would be no revenues or profits recognized in years 1 and 2. All of the profits are recorded in year 3 when the project is completed. Okay, so it's an all or nothing type of thing. On the other hand, percentage of completion method, you recognize revenues and profits as you are completing the contract. So whatever percent of the contract you're done with, you record that percentage of profits. So here's an example. This construction company is going to build an office building for $5 million, and it's going to take 3 years to complete. And according to the contract, the company is going to bill the buyer in installments over the construction process. Okay, so, whoops, what happened? Okay, so let's say that in 2013, they incurred $1,500,000 worth of construction costs. And since this is the first year, there are no prior year costs. So we have $1,500,000 in construction costs so far. We're estimating that it's going to take another $2,250,000 of costs to complete the job. So that's a total of $3,750,000, the total cost for the project. Excuse me. Okay. Year 2, they incurred another $1 million worth of cost. Add that to the prior $1,500,000 worth of cost they've already recorded. So the total is now $2,500,000. They're estimating it's going to cost them $1.5 million to finish the project. So the total cost is going to end up to be $400,000. And then in the third year, they incurred another $1,600,000 worth of costs, adding that to the $2,500,000 from the prior 2 years of costs that got incurred. The total cost is $4,100,000. And because they're finished in year 2015, there's no further costs that are going to be incurred. So the total cost is going to end up $4,100,000. You can see here the billings, what the construction company billed the client, and then the cash collected during each of the years. We'll see how that works in a second. So the journal entries related to construction is construction in progress is an account that's debited, and then cash or materials or whatever they used or paid out for construction cost is credited for that year's cost of construction. It's labor used, materials used, those kinds of things. When they bill the customer, they debit accounts receivable, credit billings on construction contract. So this is the amount that was billed to the customer. And then when they collect, they debit cash, credit, accounts receivable. Okay. So let's jump over to sorry, let's this let me go back to, sorry. Okay, the facts here. They didn't really go through the details of how we compute under the percentage of completion method. How do we compute the amount of gross profit for the year? And just excuse me for a second. Let me see if they explain that later on. Let me see. Oh, yes, they do. Okay, so I guess we'll wait for that. Okay, so sorry. Under the completed contract method, as I indicated earlier, it's fairly easy. All revenues and all expenses for the project are recognized at the end when the contract is completed. So all you do is accumulate for each year the construction in progress and the billings, and then you just record everything at the end. Again, that's the completed contract method. The percentage of completion method, you recognize profits over the life of the project as the project's completed, and we use gross profit percentages to determine how much what percent of the project is complete. So looking at the information here for that building, remember we saw all these numbers earlier, okay? First thing you do is find the gross profit in total. So the contract price was $5 million. Remember the first year they incurred $1.5 million of costs. They didn't have any costs from prior years. So cumulatively, they have $1,500,000 worth of costs. They're expecting or estimating $2,250,000 of additional cost to finish the project. So the total cost of the project is estimated to be $3,750,000. Subtracting that from the $5 million contract or sales price, we get a profit of $1,250,000. Okay, that's the total gross profit that's estimated for the whole job as of the end of 2013. What we do then is multiply that gross profit by what percent of the project we're done with so far. And the way we compute the percentage of completion is take the total cost so far, the actual cost so far, $1,500,000, and you divide by the total cost for the whole project, this $3,750,000. That gives us 40%. That's the gross profit percentage. Year two, the total cost thus far is $2,500,000. The total cost for the project is estimated to end up to be $4 million. That's the denominator here. So we're 62.5% done with the project. So we take each of these gross profit percentages and multiply by the estimated gross profit at the end of that year. So in this 2013, the gross profit is estimated to be $1,250,000 times 40% gives us $500,000. That's the amount of gross profit that we're going to recognize in year one. In year two, 62.5% times the $1 million gross profit that's estimated for the whole project. $625,000 is the cumulative gross profit. We already recognized $500,000 last year, so we're going to recognize another $125,000 this year. The third year, we're completely done with the project in this year, so the percentage of completion is 100%. We multiply that 100% times the final gross profit amount, and this is the final because at this point it's done, the numbers are all set. We know the profit's gonna be 900,000. We've already recognized those 625,000 from the prior 2 years. So we subtract that, so the gross profit this year is $275,000. Okay, so under the percentage of completion method, we're spreading out or allocating the gross profit as we're completing the project. And the way to figure out the percentage of the project that's complete is to take the actual cost to date cumulatively divided by the estimated total project's costs at the end of each of the years. And that gives us the percentage that we're complete or done. Multiply that by the gross profit estimate to get the cumulative gross profit amounts. We subtract any prior gross profit that we recognized earlier to get this year's gross profit. Okay, that's the percentage of completion method. And this is just simply showing the T accounts with the amounts of gross profit recognized each year in the red here. Okay, so as you can see, the income statement for each year will recognize the portion of the project that is complete. Again, the gross profit percentage of completion, percentage 40%, 62.5, and 100% complete. Okay. Notice under the completed contract method, on the other hand, the entire $900,000 gross profit is all recorded in the final third year. And nothing is recorded in the earlier years because it wasn't completed yet. Okay. Notice the gross profit's the same for both methods. It's just allocated or spread out among the years differently. On the balance sheet, this is what this is what it'll look like on the balance sheet. Under percentage of completion method, you'll have accounts receivable for any amounts due that haven't been paid yet. Then there's an account called costs and profit in excess of billings. And then there's a current liability called billings in excess of costs and profits. Okay. And this is kind of specialized, so don't worry so much about that. Okay. Here's a couple of differences between GAAP and IFRS. These are fairly similar, so the only difference being that if you can't estimate very well, GAAP says you have to use completed contract method. IFRS says use cost recovery method. Don't worry so much about this software thing. Franchise, just kind of a conceptual thing. Franchise is a fee paid for the right to use someone else's business name, recipes, products, etc. Probably the most famous franchise is McDonald's. Okay, people who run McDonald's restaurants and own McDonald's restaurants pay McDonald's corporations a fee for the right to use the McDonald's name, use the logos, and use the products and sell the products in their stores. That's a franchise. There's franchise fees. There's an initial fee. You pay a one-time fee to McDonald's in order to be able to open a McDonald's restaurant. I think that's in the $3 to $4 million range. In addition to that one-time fee, there's a monthly franchise fee that's paid as a percentage of your sales generally. So a certain percent of the sales for each restaurant goes to the McDonald's Corporation. Okay, those are franchise fees. Okay. Ratio analysis, there are here some ratios. These measure the activity levels of a business. So asset turnover ratio is your net sales divided by your average total assets. And average total assets are your assets at the beginning of the year plus your assets at the end of the year. Take that total and divide by 2. Likewise, receivables turnover ratio is net sales divided by your average accounts receivable, which again are your receivable at the beginning of the year plus accounts receivable at the end of the year. Total those, divide by 2. Average collection period is 365 days divided by that receivable turnover ratio that you just calculated. And that measures, again, receivable turnover ratio measures how quickly, how many times during the year that a company sells and then collects on the receivable, related receivable. Average collection period is sometimes an easier way to look at it. It's you take 365 days divided by that receivable turnover ratio we just calculated, and that tells us how many days it takes to collect receivables. And sometimes it's it's an easier way to look at it as far as receivables. Inventory turnover ratio is cost of goods sold divided by average inventory. If you take that average inventory and inventory turnover ratio, and divide it into 365, so 365 divided by inventory turnover ratio, that tells us average days inventory. How many days does the inventory stay there before being sold? Okay. All these ratios, like any other ratio, are only meaningful if they're compared to something. Okay, either to their own ratios from the prior years, from competitors' ratios, or for the industry average. Okay, but you got to compare it to something. Those are called benchmarks. You compare it to something, and that determines whether these ratios are good or bad. Okay. Profitability ratios, you can see here, net income divided by net sales gives us profit margin. Profit margin is how much do you make on each dollar of sales you have. Okay, and that's a percentage. That entirely depends whether a profit margin is good or bad, depends on the type of business you have. For example, supermarkets, grocery stores, their profit margin is generally 2%, very low. Jewelry stores, on the other hand, their profit margins are fairly high, sometimes as high as 100 to 200%. Okay, so again, just like all other ratios, you need to compare these to something else in order to determine if these ratios are good or bad. Okay, so these profitability ratios here that are indicated all measure how profitable a company is. Okay, and again, how profitable, you need to compare these to something else. Dupont Framework, don't worry so much about this. It's a fairly complex set of ratios, and it's called Dupont Framework because the Dupont company was the one who kind of made this, popularized this. Okay. In the appendix, I'll just quickly talk about this terminology here. Interim reporting. Companies are required to prepare financial statements on an annual basis. And every company does that. But some companies prepare financial statements for a period less than a year, usually quarterly, sometimes monthly. Okay. And this, obviously, the more often you prepare financial statements, the more timely they are, and the more meaningful they are, because they're more recent. Okay. Certain companies, well, basically what this slide is saying is that when you do interim reporting, you do the same thing you would do when you do annual reporting, except you have to do these things more often. Okay. Don't worry about this. Here's just a list of things at a minimum that must be included in an interim report. The interim reports are not, let me go back. Interim reports are generally not required unless it's a publicly traded company. Publicly traded companies are required to do interim reporting on a quarterly basis and file a report with the Securities and Exchange Commission. That report's called a 10Q report. The annual report's called a 10K report. And so for those kinds of companies, publicly traded companies, they have to prepare financial statements on a quarterly basis. Okay, here's just a recap of the key concepts in the chapter. Okay. Don't worry. Well, you can go through this on your own. Don't worry so much about this. Time value of money. Don't worry about this yet. Let's see what else is good. And that's basically chapter 5. Okay. So until next time, aloha.